I think that this has got to be shocking to real estate investors, and it's shocking to me. I mean, I wouldn't have guessed that the global average on a few $billions of real estate that we analyzed would be 1% cash return on equity. That's a lot lower than I expected.
You have these dollars sitting in your property and you want to make dollars off of those dollars. So that's why you're looking at your cash on cash return. But over time, those dollars in your property build. So then the question is, okay, are these still working as hard for me as they were when I bought it? The answer is probably no. So then the question is, do I want to do something else with these dollars?
So through our Property Llama real estate software application, we just finished reviewing 6,858 properties to extract a lot of data. We're in a very unique position where we have a large data set, and also we talk to a lot of investors. And on top of that, we also know what their goals are. So the purpose of us reviewing this data and doing this recording is so we can contextualize, help you understand the opportunities in the marketplace, common mistakes people are making in their portfolio, then how to get to your goal. And the shocking thing is cash flow is not the best way to make money from real estate. And I got two people here to dive in the data sets with me. One is Richard McGirr, who is the co-founder of Property Llama, and he was able to get all the data for us. Richard, hello.
How you doing, Chris? Thank you.
I'm doing great. And our second special guest is Miller McSwain, and I think your official title is a nuclear rocket scientist, who I met years ago because he was actually doing deep data sets on the International Space Station while he was interning, then moved out here to Colorado and is now investing in real estate. Welcome, Miller.
Yeah, thanks so much for having me.
So it's really exciting here because it's very rare where I've got someone, in my opinion, with a lot of data experience like you, but also like you're in the trenches with real estate. You own how many properties now?
5 properties.
5 properties. Okay, so like you're not just gonna be like, hey, here's a spreadsheet, but you can talk about the spreadsheet and also like you roll up your sleeves.
Yep. Yeah, we've been in it long enough that now we know what the numbers mean. And yeah, luckily, we have the skill sets at this table to dive into the data and get more into it.
Yes. So I want to start off with cash flow because why'd you guys get into real estate investing? For cash flow, right? That is the number one thing everyone gets into real estate for. I got into, you and you guys got into as well. And so there's a really interesting thing going on here where people look at cash on cash return. And I think that is a horrible metric to look at. Not for buying the property, but for once you own the property. Richard, you own properties, Miller, you own properties. And cool, your cash on cash return today, when you look at a property, is not accurate. So to talk about that is, let's just say you're making a 10% cash on cash return. Well, we're looking at today's dollars. In 2024, you're getting X amount of dollars. And then you're saying, 5 years ago, 10 years ago, I invested $50,000 or $100,000. So we have our numerator in today's dollars, our denominator in 5 or 10 years ago. There's a mismatch when it comes to the time value of money, and it's not apples to apples. Does that make sense?
Yeah, it totally makes sense. And, we talk to investors about their portfolios day in, day out, 3-4 investors a day. And the way that everyone talks about their portfolio is that they have a cash flow goal too. So it's the reason they got in, and it's also like the main metric that they're focused on because they want to, retire their spouse in 10 years. And that most of the moves that they're planning with us are about how are we going to get that cash flow higher?
Now here, before we get into more of that, there's cash flow today and there's cash flow in the future. And that's always a fine thing, right? We all want more cash flow today, but most of us don't have it right now. And so we have to, hey, how can I get more cash flow tomorrow or in the future? So I want to bring us back here to a metric I think is the most important metric for investors to realize, and it's called cash flow on equity. Because Rich, if you have a property 10 years ago, you have your investment, and maybe put that $100,000 on the properties you own in Colorado Springs, what's happened over the last 10 years?
They've gone up in price a lot.
Yeah, your $100,000 investment may now be worth $300,000 in equity between market appreciation and also principal reduction. So is it better to say, hey, I got $100,000 in this property, or do we look at it at $300,000 at today's equity? How would you view that, Miller?
Yeah. I think just the main way to think about it is that you have these dollars sitting in your property and you want to make dollars off of those dollars. So that's why you're looking at your cash on cash return. But over time, those dollars in your property build. So then the question is, okay, are these still working as hard for me as they were when I bought it? The answer is probably no. So then the question is, do I want to do something else with these dollars?
Yes, very well said. Because that equity in all of our properties is opportunity cost. Like that's real money in there if you sell the property. If you do a cash out refinance, you can extract that. So that's why we have to look at everything on what's the cash flow on equity. Now, we are going to dive into, and this is like the tip of the iceberg with data that Richard pulled, Miller analyzed on here. We got lots of charts coming up over many, many podcasts in the future here. But we want to look at what the cash flow over equity is. So Miller, you pulled all this data and you pulled this chart here. How can you explain it to us? Because we got some people seeing it, and how would you explain it? And what was your big takeaway?
Yeah. Yeah. So this is basically showing, right? We looked at data from people who already own properties. This isn't people analyzing properties. This is folks who already own properties. And so right here, we have broken out the cash flow over equity, like we were just talking about. So how much are you cash flowing per year divided by how many dollars do you have sitting in your property in equity right now? So that's what we have here on the left axis. And then we just have it broken up between different asset types. So we have our single families, condos, large multis, townhomes, and small multis. And so, yeah, there's plenty of takeaways that we could pull from this.
Yeah, and let's start with here. We'll kind of keep going at the 30,000 foot view on here, and we're going to do this blended one right here of all the asset classes. On average, between those 6,000 plus properties was at about just under a 1% cash on equity.
Yeah.
So let that sink in. So let's just say you have $500,000 of equity in a property. That means what's 1% of 500,000? $5,000, right? I'm doing my math right live. So that means that $500,000 equity is generating me 5% or $5,000, which is, we'll round up about 1%. All right. Are you guys sophisticated investors and go out there and get more than 1% cash flow right now in investment?
If I was optimizing for cash flow, I could do way better.
Yeah. I mean, I have a really cool secret. It's called a high yield savings account.
Yeah.
And they're paying like 4.5% right now. T-bills are 5% plus right now.
Yep.
And so I'm going to push on here because this is something I like to get in like debates about with people, because I want cash. I'm like, girl, I get that too. Play devil's advocate on. If you want cash flow, then this is not the best cash flowing asset right now for you. There's high yield savings account, there's T-bills, there's debt funds, there's other stuff that goes out and it pays more cash flow. I'm not saying it's the right thing. I'm just saying you put it on a spreadsheet. The spreadsheet says do this instead. So when you guys hear that, I mean, what's your reaction?
Yeah, I mean, that is what the data shows, that, yeah, if you're going to get a 1% return on as far as cash flow goes, there are some potentially better alternatives. And I guess if you want to retire off cash flow and all that, you need to do something better than the average. Yeah. Better than the average asset class, better than the average strategy, because 1% is pretty abysmal.
I think that this has got to be shocking to real estate investors, and it's shocking to me. I mean, I wouldn't have guessed that the global average on a few $1 billion of real estate that we analyzed would be 1% return. Cash return on equity. That's a lot lower than I expected. Yeah.
And there's a lot of reasons on here. We're going to dive into the different asset classes on here. There's also, hey, if you bought a property, yesterday, Richard, and I bought a property 20 years ago, well, I got less debt on the property, so I should be making more cash flow, right? The other thing to think about here is the reason I like to just push people on here, like devil's advocate, is because there is headache. There is real risk from the property of damage or liability that you have to deal with. And so if you're really optimizing for cash flow, well, that monthly cash from your property may not be the right answer. So let's dig into asset classes here, and we're going to start left to right. And so we have single family homes. So these are detached single family properties, which, is probably one of the most common assets for real estate investors, and probably in Property Llama, right, Richard?
Probably, yeah.
Okay. So
by a long shot.
Miller, what is that in terms of cash on equity for single family?
Yeah, it's negative. So
I want to make sure I was reading that right.
It is negative, yeah.
So it's like negative 0.2%, right?
Yeah.
I would say, or so 0.1. So I mean, like, say break even, slightly negative. Now, this is all the properties or all the single family properties, over the last 30 years of people. So it's a high level. But take on average single family, it's essentially neutral to slightly negative cash flow. Holy smokes!
Yeah.
All right, now let's over at condos. Condos are just under about a 1% cash on equity. Why do you guys think that is?
Yeah, I think probably just the mortgage payments are lower because they're cheaper assets.
Better cap rate.
Yeah. I mean, historically, at least in Denver now, a lot of the data we have now is outside of Denver, Colorado in Property Llama last things. We got a lot more national investors over here. And I know the trend for years in Denver was condos were historically cheaper, or they are cheaper than single family homes. The rents were a little bit lower, but the rents did not have as big of a disparity. And we factored in all the other stuff. Condos usually cash flow better. So I'm not surprised by that. Now, let's talk about townhomes. And this one surprised me because townhomes, so again, single family homes, but they have the shared walls on there, about a negative, 0.3, 0.4% on that graph.
Yeah, it's
What's
the worst
that?
one on there for sure. Yeah.
Yeah. This one was the most surprising to me. You guys have any ideas why? I've been thinking about this because I don't
Yeah,
have a
I
good.
mean, they're cheaper just like condos, right? So why is it so much?
Yeah,
so
but
much
I would
less?
think the cash would be
Yeah.
higher on that.
Yeah.
I would think it would be somewhere between single family and a condo is what I would have assumed.
Yeah. This is why, like, and part of this, we're just going through real time right now, looking at this data, discussing it, and this was the biggest surprising of the data set out here for me because I thought they would, be between a single family and condo type, but they are not. All right, now the best cash flow on here is actually in multifamily, and we're going to divide this between small multifamily and large multifamily. Small multifamily is a duplex, triplex, or fourplex. That is a residential multifamily there, and we are at about 3.5% cash flow on equity for a small multifamily.
That's decent.
Yeah.
In the world of investing, that's getting pretty decent, especially because the return, like this is a growth and a cash asset at the same time. Like you're still getting value growth. Like 3% return on an asset that also appreciates is pretty great.
I agree. Now, large multifamily, we are sitting at about 5.7% cash flow on equity. So if you guys are able to see the graph here, this bar graph just towers above the other asset classes here we talked about.
Shocking.
And so this is anywhere from 5 units and up. And we don't track the specific unit account in Property Llama, which we know it's just commercial assets. So
5 plus.
5 plus.
Yeah.
A lot of times that's going to be between, when I've looked at portfolios, that's between a lot of times like 5 to 25 units is a lot of like where that falls into, because that's where most individual landlords can afford and operate a property. So, it's kind of in that range for like most of that data, but we're about 5.7%. So you guys have any idea why that is?
I mean, large multi and small multi were built to cash flow, right? Whereas, most of us who are getting into the game and buying the condos, the single families, whatever, I mean, they were built for a family like your family and all that sort of stuff. But now you're getting into sharing multiple units within under one roof. It's just absolutely built to do this, and it's doing what it's supposed to do.
Yes. That is the goal of multifamily. So this brings us to the second lesson here we can take away from this data set here is that there is a huge opportunity. If you're looking to maximize cash flow, I would definitely look at multifamily. And to build upon what Miller said here, those were built to cash flow. Now, well, then if that said, we should see the same cash flow between small multifamily and large multifamily, right? Well, you would think from that statement we would, but let's dig a little deeper here. Because anything under 4 units or less is considered single family residences, which I know is really, it doesn't make sense because we're talking 4 units. It's still considered single family residence. So that means 4 units or less, according to the higher powers in the government. So commercial is 5 plus. Well, whether you're buying a single family home or a fourplex, the way those are valued are off of sales comps or sales comparables. So even though a fourplex is going to be more geared towards cash flow than the houses we live in ourselves, our primary residences, they're still going to be based off of sales comps. Where you look at the large multifamily, those are based off of income comps.
They're pure financial instruments.
Yes. Talk more about that.
Yeah. I mean, so when you say that multifamily is traded on its income, what that means is that the price you pay for it is whatever the prevailing rate, a multiple of that income. So I'm willing to pay a 5.5. And that the price of that goes down if debt gets more expensive because there is an expectation on both sides of the table that I'm going to buy this asset and it's going to produce cash flow for me.
Yeah, because when people buy multifamily or buy any commercial asset, they're essentially buying an income stream. Just like when you buy stocks or buy a bond, you're saying, hey, here's the income I expect to get from it in some form. And that's why people are buying that. So with residential properties, that is more of, well, hey, we've got just non-real estate investors buying a property to be in a good school zone, to be near their job or to upgrade their house for their growing family. They don't care about rents. And if rents grow or rents shrink, they're not going to impact the price of a single family because people are going to buy there for their personal use. Where multifamily, if rents go up, that's more attractive. And a lot of times prices go up. If rents go down, prices will go down because, again, people are buying an income stream. So talking about maximizing cash flow on here, this is where it starts getting, I guess trickier might be the right word. Well, how does someone bridge the gap from single family to multifamily? Because if you want cash flow, that might be the best way, right? We got to get our single family rentals and go into multifamily. Is that the way you guys would interpret this graph?
Yeah. I mean, I think the single family homes, right? They're lower barrier to entry. That's what everyone can start out doing with house hacking or even just buying non-owner occupied stuff. But so, I mean, I think it's a good spot to start out and like you can grow your equity there. Like over time, you can start to build equity. And at some point, now you've passed the barrier to entry to hop into something that is going to cash flow and get you to your goals. But yeah, it'd be better to do it that way, I think.
Well, and not just you can get into something better, but you're kind of feeling a day one impact of I'm going to increase my cash flow 5 times by transitioning the equity from this single family home into this multifamily asset. I mean, usually people, when you look at their goal and they're like, I'm at $5,000 a year, a month in cash flow. They've got a very good portfolio, let's say, but I think I need to get to 15,000. You could move like one asset and bridge this gap. I mean, that is 5 times. That's an enormous move.
All right. So to simplify this, and I view a lot of real estate investing in life just as a game. That's how I simplify things and keep things fun for me. In my mind, we are just playing real life Monopoly, right? We go out there, we have our greenhouse. That's our single family homes. We ultimately want to get the red hotel. That might be a 5-plex, a 10-plex, a 20-plex. And so how do we go from one greenhouse to 2 to 3 to 4 to that red hotel, which represents the large commercial multifamily? That's the way I view it in my mind. So this brings up a really tried and true technique that investors have done for decades. And it literally shows what Monopoly taught us when we were 5 years old playing that game. Is that we want to take the equity from the single family homes we've built, because the biggest return has not been cash flow from single family homes. It's been the equity or the appreciation, right? We all know what's happened the last 15 years. Since the 2008 crash, we've been in this huge recovery where, I mean, we've just been a lot of times double-digit appreciation growth every year. So, thing of fact, the market said, hey, Miller, hey, Richard, I'm giving you way more appreciation than cash flow for your properties. It's not good. It's not bad. It just is what it is. Okay, so how do we take that equity and go out and convert to cash flow? Now, this is a chart, equity versus purchase year. And Miller, can you describe this chart to our listeners and give us a takeaway from it?
Yeah, basically this is just showing that if you bought a property more recently, you're going to have less equity. You just bought it. You haven't paid your loan down yet. The property value hasn't grown a ton. But the further back that you purchased the property, the longer that you've owned it, you're paying your loan down more. The property values continue to increase. So you have more and more dollars sitting in these properties the longer that you hold them.
Yeah. And it's an objectively large amount of money. Like when you get to properties purchased in 2007 and you're looking at having over $400,000 in this thing, that is some major dry powder.
It's real money.
Yeah, that's an objectively large amount of money.
Yeah. Well, here's the thing. It's not dry powder, though, because it's equity.
Oh, yeah.
Very
right?
I jumped too far ahead. Right.
No, but you bring the point like, hey, so now take this away. Let's just say, I love where you went with here, because let's take it away. Hey, if there was an equity at $400,000, what would you do with that?
Yeah.
If you had $400,000, would you buy that single family residence today? Probably not. But a lot of times you say, oh, well, it's in there. I'm going to leave it in there. But if you kind of ask, hey, if it was actually money in my bank account, what would I do with it? And when I ask that, 99% of the people tell me it's not to buy that same property again. They'd go out there and buy something else. So the key point here is that obviously time and market matters a lot. We all know that saying, hey, we let equity build over time between market value, market appreciation, debt pay down. And if you can add some value of force appreciation, yes, take it. But we have to take the equity and convert it to cash flow. And the way you do that is by pulling it out of the property. Now we can do a cash out refinance. You go buy another property. We can sell in 1031, or you can simply sell and cash out. Now, there's a bunch of pros and cons to each of those, and we won't get into all those right now. But from a high level, like cash out refis, they just don't make sense in the market right now. When you put high debt on there, buy another high property debt, the numbers don't make sense. Why? Well, because since the single family rental you have is a poor cash flowing vehicle, putting more debt on there and more expensive debt all of a sudden makes it a negative cash flowing property.
Dramatically worse.
Yeah, when I have run scenarios for people, hey, they're making $5,000, $10,000 a year cash from the single family. They do a cash out refi, now it's like negative $15,000 a year. No, cool, you pulled out a couple $100,000, but now you have a negative cash flowing asset. It's not good investing advice.
That's not why you were in this game in the first place. It's a step in the wrong direction.
So what I have done, I've done both these. And I think this is something I'm going to encourage everyone to do. If you want cash flow, I'm going to give you two options. You should sell, do a 1031, and go into a large multifamily. Hey, the bigger you can get, the better you can get, obviously, for cash flow. Or you simply sell and cash out. which I know is a little shocking, but let's look about this. If you want cash flow, what's the difference of making $10,000 a month over a year, or I give you $120,000 check at once in 1 year? There's some
I'd take 120 all day.
Why?
Because it would take me 12 years to make that same amount of money.
$10,000 a month. So in 1 year,
okay.
I can give you $10,000 a month, or I can give you $120,000.
Are you giving the 120 now or in a year?
Whatever you want.
Okay. Well, if you were giving it to me in a year, I'd rather take 10,000 a month because now I have more money to play with over the year. But if you're going to give me 120 today, I mean, obviously I'd take that and just do something cool with it, make more money with that. Yeah.
You're right, because time value of money, right?
Exactly.
Now, I gave an example where, we were saying cash flow is the same as like a big lump sum thing by selling. Well, it doesn't work that way in life. Going back to the single family rental properties, if I'm making $10,000 a year, let's just say $1,000 a month for easy simplicity. Well, great. Or next year, I might make $1,000 a month in cash flow, or I can sell my property and take away $300,000 in equity. Oh, now these are way bigger differences. What are you going to say, Richard?
I said I wasn't paying attention clearly when you asked the question. That's kind of what I assumed you're asking. Like, would I take $300,000 from this property or the like $2,000 a month in cash flow that I get from it today? Yeah, I'll take the $300,000. Yeah.
But investors don't look at it that way.
No.
Right? And so this is something that I learned a couple of years ago from investors who are much smarter and much richer than I am, because they're like, yeah, I care about that exit price because that's where you get the big money. The monthly cash flow does not get you rich. And so a lot of people say, I'd rather have that one big check once a year, every couple of years to go reinvest or live off of. And so it goes against really, all the standard real estate training, all the classes, all the spreadsheets, all the words. It's about monthly cash, right? That is what's ingrained in their heads since we probably first learned about real estate investing. But it's the wrong move if you want to maximize cash flow. So this brings up a topic here, monthly cash flow versus lumpy cash flow. Mm-hmm. And so for people out there who want to maximize cash flow right now, again, this is people who bought properties a couple of years ago. They've got a large equity position. Well, I'm going to challenge you and say, maybe you should sell and take that big lumpy cash flow because you have more cash in the bank.
It's also a lot more cash. It's cash that you wouldn't be able to spend otherwise. It's literally trapped in a property. Like, it's not even, I'm going to get this eventually. Like, no, the only way you're getting this is by selling the property, period.
So here is the next counter argument or objection I get from people. I'm going strong and play devil's advocate on them. They say, well, I have to pay taxes on that. And so I've always been boggled by this because people say, oh, I can't sell a property because I pay taxes. The worst thing in the world. I'm like, you pay taxes on rental income as well. Like, you pay taxes no matter what. Yeah. Like, that is one of the pros and one of the cons of living in the country, right? We all pay taxes. But here is what I want everyone to think about. When you get rental income, hey, check comes in, you pay your bills, you pay your mortgage, you're left over with $1,000 a month in cash flow. How is that taxed, guys?
Income.
Ordinary income.
Yeah.
Which for a lot of people, depending where it might be between like 20 to 40% between federal and your state tax rate. Now in Colorado, a lot of people are like 25 to 35%. If you're a high income earner, you're going to be in the low 40s. Now, if I sell a property after 1 year, how is that taxed?
Capital gains.
Long-term,
probably.
Long-term capital gains.
Yes.
What type of tax brackets are those?
Like half.
Yeah. A lot of times they're like 10 to 20%. Now there's a few other things on there, but I'm just going simplistic on here. So 10 to 20%. Now, I used to go through and say, oh my gosh, can't pay taxes. Well, I'm paying taxes no matter what. Now, if I can get more cash flow, now it's a lumpy cash flow, one big check. Yes, I'm paying a larger tax bill, but my effective tax rate is half of what I'm paying on a lower amount. How does that change how to look at cash flow?
And it's dramatically more money.
Yeah. You're getting more money and you're paying a bigger tax bill at once, but it's an overall less tax burden.
Yeah.
And so this is where I want to encourage every investor to go out there and really think about, because this was like a 2x4 to my face when I started going through. I was like, well, this can't be right. This can't be right. But then I built the spreadsheet. This is right. Hey, someone check this out. Am I crazy? No, this makes sense. And yeah, checked with my CPA, of course, as everyone out there should. Talk to your CPA because we're not CPAs. If you want cash flow, sell the property, buy a multifamily, or sell the property and take a lumpy cash flow.
Yeah, and also a big part of that is just take the win. I mean, because if you have a huge run up on a great investment, you should take the win, at least for part of that. Take it in cash, put it into bonds, put it into stocks, whatever, but take the win, trim the position.
And if you think about this too, or for someone, I forget do you know the average number of properties our portfolio has per user? I don't know if you know off the top of your head, you guys.
No.
I mean, it's multiple.
I think the average is probably going to be like three or four.
3, okay. So let's say you have 4 properties, and a lot of
Yeah.
people have, usually it's 1 or 2 or like 10. So let's say you have, a handful of properties. Well, you don't have to sell everything,
No, exactly.
in March of 2024. Hey, maybe you sell one this year.
That's
And
exactly.
a year or 2 later, sell another one. And so for people who want to maximize it to like live off of it for a lot, especially as they kind of get more retirement phase or want to reallocate it to like better cash flowing assets and less risky and less hands-on, that's a really simple way to like take some big wins, take some big chunks of cash, actually minimize your tax burden, per dollar you're coming in, and reevaluate and reinvest your portfolio to maximize cash flow.
And also like life events come in. Why were you saving up all this money? If a kid going to college or something like that. Yeah, sell a property. It's not the end of the world.
So all of this, I think you guys know, a lot of the, some of our listeners know this. I've sold 3 rental properties in the last 6 months, probably 8 months now. Guess what I did with that?
Reinvested a lot of it.
Yeah, but I did not do a 1031 exchange.
Yes.
Oh.
I took my wins. I paid my taxes on there. And I did reinvest in some other real estate to get depreciation offset. But I still paid some tax on it because I ran the math. I was like, you know what? At this time in my life, at this time in the life cycle of that rental property, and usually 5 to 7 years is a sweet spot to like maximize when you want to sell the property, extract cash flow. And the fact that the current market cycle, like going out there and doing a 1031 into another property is just really tough right now. I was like, you know what? I'm going to sell these properties, pocket some cash, and then go reinvest in cash in some other assets. A lot of commercial stuff as multifamilies, some development stuff. But it wasn't me owning it myself. It was me investing with other people. And I'm just a partner in those. And I'm getting the best cash flow that way as possible. I'm actually getting more cash flow today. And those new investments, a lot of them are spinning off 5 to 10% cash on cash return.
Yeah. I mean, it pays off if you're smart and you invest over a long time horizon and you build all this equity. Awesome. Be more passive after that. In this case, you're even getting more cash flow from doing that. So that's awesome. But yeah, take it and do something better with it.
So, and as we wrap up here, I'm gonna turn the table on you, Miller. If you don't mind, how old are you?
25.
All right. So you're 25 and you own 5 properties now?
Yeah.
And those are all, I believe, room by room rentals, right?
Yep. All single family properties that are rented out by the room.
Why are you doing room by room rentals?
Because as you saw, single family rentals, renting them out traditionally, negative cash flow, close to zero cash flow, something like that. So single family rentals have, like I said, the lower barrier to entry. So it's something that I could get into when I was 21 years old, 22 years old, whatever, just keep buying them. And we're just doing something special to enable, the cash flow that we can pull out of it. So yeah, lower barrier to entry, and then do something to get cash flow that's special.
What's your blended cash on cash return for the room by room rentals?
It's 12%.
12%. So
Yeah.
those numbers we want to see. And so when we talked to them earlier, those were long-term rentals. Hey, I buy a property, I put one tenant or one lease in, a family or whatever
Right.
it is, where you have 5 bedrooms and 5 tenants, right?
Yep, exactly.
And you're also at a phase where like, hey, well, the phase you're like, hey, you're younger, so you can put the time into there. You also have usually the more time and less money aspect of your career. And in terms of market, that's the best cash flow to get.
Mhm.
Now, eventually what happens is you start getting so many assets where, an extra $1,000 a day is not as important as it was to you when you're 22.
Mhm.
You also start building up larger equity positions between debt pay down and appreciation. I imagine at some point you get busier with career or getting the family planning, right?
Mhm.
So as things go along, then you want more cash flow. Well, then you will start selling these to take the wins or sell them and invest in multifamily or invest with, Miller 2.0, the next
Yeah.
up and coming guy that can go out there and take the money and give you great cash returns, right?
Yep. Yeah. I mean, that's probably something that's in the cards. It is, like you said, kind of tough to think about as an investor now. Like, okay, I worked so hard to find all of these properties. I put all this work in to get them under contract and close them. And it's like, I don't know if I really want to sell them. But I mean, if you do look at the numbers, there is a point in time where that makes sense if your goals are cash flow.
Yeah. All right. So, like I said, this was tip of the iceberg. And Richard did an amazing job of extracting all the data. Miller did a great job of going through and doing some data analysis I've never seen before.
Yeah.
So thank you so much,
course.
Miller. And we're going to do, we touched on like one out of about I think 15
Yeah.
data points you pulled, and we have like a list of more to do. So we're going to do more topics on here, but we said, hey, what's the most important thing? And cash flow is the main metric and the main reason we get into real estate. So we want to talk about cash flow on here. So investors out there, come back, let us know. Are we insane for saying, hey, sell properties, take lumpy cash flow? YouTube comments are always fun, so fire away. Or most importantly, I want to challenge your thought. I want you to go on there and challenge where you look at your portfolio. So if you have not put your properties in Property Llama, go do so. And then take the stuff we talked about, the cash on equity, and then go look at your tax brackets. Go look at the overall cash you could get. Run through the talking points we talked about and let that think and marinate on that and see what moves might be the best move for your portfolios. Miller, thank you. Richard, thank you. This was an absolute blast.
Thank you.
Thanks, guys.